Welcome! In this analysis, we are breaking down the first half 2025 financial results for CITIC Securities. We'll be examining not just the performance, but also the critical strategic positioning of China's leading investment bank.
So, here's our roadmap. We'll begin with the core findings right up front. Then we'll dissect the company's four main business engines. From there, we'll assess its valuation and industry standing, explore the broader bull market vanguard logic, and finally, we'll identify the key future signals to watch.
All right, let's get straight to the headlines with our conclusion-first approach. The big story here is a really interesting contrast. On one hand, you have net profits soaring by nearly 30%, but on the other, operating cash flow actually declined. Now, this isn't an operational issue. It points to a very deliberate strategic choice to increase market risk exposure. And this is all happening while a valuation gap seems to persist, despite the company's excellent profitability.
Okay, first up, our core findings. Let's really dig into this apparent paradox between profit and cash flow.
So let's start with the headline number, and it's a strong one. Net profits surged by almost 30% year over year, hitting 13.72 billion yuan. This really demonstrates some significant earnings power, particularly in what was a more favorable market environment.
But, and this is the crucial part, when you turn to the cash flow statement, you see a completely different picture. Net cash from operating activities actually fell by nearly 19% year over year.
This divergence naturally raises the critical question: where did the cash go? It's a key piece of the puzzle we absolutely need to solve.
And the answer, when you dig into the report's details, is quite revealing. This wasn't a sign of deteriorating earnings quality, not at all. It was a very intentional, strategic allocation of capital. CIT actively chose to increase its holdings of trading financial assets and to expand its margin financing business. Put simply, they were converting cash into market-facing assets, positioning the firm for anticipated market strength.
Okay, so with that strategy in mind, let's move on and break down how it actually played out across CITC's four core business engines. If you look at the revenue mix, the securities investment business is still the largest contributor, at nearly 44%. But honestly, the key takeaway from this period isn't just one division. It's the strong, broad-based growth that we saw across all major segments.
And this table really puts some hard numbers to that story. Just look at the brokerage and asset management divisions. Both grew at over 20%. Now, a huge driver for this was the market environment itself. Trading volumes shot up by almost 64%. This just highlights the powerful operating leverage these businesses have when the market is active.
This kind of robust performance, of course, means we have to analyze CITIC's valuation and its position within the broader competitive landscape.
Now, in a peer comparison, CITIC's percentage growth might look moderate, but it's important to remember they're working off a much larger earnings base. A far more insightful metric here is profitability. CITIC's annualized return on equity comes in at nearly 9.8%, and that significantly outperforms the industry average of 7.5%. That really speaks to its efficiency.
And this brings us to a clear disconnect. On the one hand, you have superior profitability, but on the other, its price-to-book ratio of 1.61 times is nearly identical to the broader markets, which is in a historically low valuation range. What this tells us is that the market is not currently assigning a premium for CITIC's leadership position or for its higher quality earnings.
This valuation observation leads us right into a broader market theory, the well-established role of securities firms as leading indicators or vanguards of a bull market.
The fundamental economic reason for this is their inherent high beta nature. Think about it. Virtually every core revenue stream, from brokerage commissions to asset management fees and investment gains, is directly and positively tied to market direction and activity. So, a rising market doesn't just benefit their business model, it benefits it exponentially. This economic reality creates a powerful reflexive loop within market psychology. It often starts with anticipation. Investors expecting a recovery buy brokerage stocks first. Their rise is then seen by others as a confirmation signal, which attracts broader market participation. And then, this increased activity validates the whole cycle by improving the broker's fundamental earnings. It becomes a self-reinforcing prophecy.
So, given this entire framework, what are the specific, data-driven signals we should be monitoring to validate this thesis going forward?
We can really group these signals into three distinct categories. You have the top-down macroeconomic and policy drivers, then there are the direct, quantifiable market-level indicators, and finally, you have company-specific developments that would confirm strong competitive execution.
Now, among all those market-level signals, there is one quantitative benchmark that is absolutely critical to watch: 1.5 trillion yuan. This figure for sustained daily market turnover is widely regarded as the threshold that indicates a shift from a simple recovery phase into a genuine bull market.
And so we're left with a very clear analytical framework, an essential forward-looking question. Which of these signals, from policy actions to market volumes, will be the one to emerge first and confirm the market's next definitive trajectory?